Thanks for joining us on lunch. This is BloombergQuint. I'm Harsha Subramaniam. The headlines at this hour. The Nifty and Sensex fall almost 1% each. ICICI Bank and HDFC lead the decline. The suspended MD of Punjab and Maharashtra Bank, K. Joy Thomas, admits to underreporting on the bank's exposure to HDIL in his letter to the RBI. The RBI puts Lakshmi Vilas Bank under its prompt corrective action framework, citing higher NPAs, weak capital position and negative return on assets. And the Indian Railway Catering and Tourism Corporation IRCTC looks to raise 638 crore through its IPO. The issue is open for subscription. US Treasury says it has no plans of restricting Chinese companies listing on Wall Street, even as Bloomberg reports that the Trump administration may cap US portfolio flows into China. We'll get to those stories, but quick check on how the markets are faring right now. Yatin is here with a closer look as always.
Good afternoon, Harsha. And the clear weakness in the NBFC as well as the banking space has impacted the overall market as well as the key benchmark indices. In fact, if you look at the Nifty 50, it's trading about 1% lower, 100 points down on Nifty 50. The level is close to 11,400. And if you look at Nifty 50 advanced decline ratio, it is almost 13 stocks advancing to 37 stocks declining. A majority of that is the financial space. Of course, what's keeping the markets higher is the entire IT pack. So we have HCL Technologies, Infosys, TCS, Tech Mahindra being the top gainers on the Nifty at this point in time. UPL is up 2.5%. Of course, there is some M&A action in Latin America, especially in the crop protection space, which is helping the rally in UPL. Talking about the financials, look at Yes Bank. That stock is at probable record lows in trade today, 12% down for that one. IndusInd Bank is down 6%. ICICI Bank as well as SBI, both of these stocks are the heavyweights on the index. Both of them down 3.5%. And similar is the case with the key NBFCs. Look at Indiabulls Housing. That stock was down as much as 38% intraday. Has recovered from the day's low, but still down 31% in trade right now. Of course, this is to do with the prompt corrective action rub-off, with respect to Lakshmi Vilas Bank. That stock is also under pressure. Talking about other NBFCs, Piramal Enterprises is down 6.5%. That stock is clearly under pressure, especially in the future and option segment. With that, RBL Bank is also under pressure. So the entire private banking space as well as the NBFC space is fairly under pressure for the trade today.
Jason, thank you for that. Suspended Punjab and Maharashtra Bank MD K. Joy Thomas is said to have owned up to not disclosing the exact exposure to HDIL. Thomas, in a letter he wrote to the RBI, has pegged the amount at 6,500 crores. That's 73% of the total loan book. Ira standing by to take us through the details.
What started out looking like an example of weakness in a cooperative bank, and honestly in India, it's not unheard of to see cooperative banks run into trouble, has taken staggering turn in the last 2 or 3 days. We are talking about the Punjab and Maharashtra Cooperative Bank, where the RBI had placed restrictions last week. Deposit withdrawals have been restricted first to 1,000 and then raised to 10,000. But the information coming to light over the last few days is truly worrying and shocking in some ways. We have learned from people directly in the know that the bank had given loans worth about 6,500 crore to entities related to the HDIL group. Now, the MD, the former MD of the group, Joy Thomas, had actually held a press conference on Friday, a slightly bizarre one. And in that, he said that the extent of loans to HDIL were 2,500 crore. But in a confession letter to the Reserve Bank of India, he's admitted that the extent of loans is 6,500 crore, and that is almost 70% of the bank's total loan book of 8,800 crore. Yes, 70% of the bank's loan book is to entities related to one group. Just for reference, the RBI's rules say that you cannot lend more than 40% of your capital to one group and 15% to one entity. So way in excess of all of those limits. Also, because the HDIL group has run into trouble, is undergoing insolvency proceedings yet to be admitted. A lot of these loans have gone bad. So the former MD has admitted to the Reserve Bank of India that about 70% of the bank's total loans are now stressed or in the bad loan category. Compare that to what was disclosed at the end of March 19, which was just 2.91%. So essentially, all of the disclosed data by the bank is not believable anymore. That's the starting point. And what has been happening behind the scenes is that loans have been given out to HDIL Group. How did they actually do this? That's the question question being asked, why was this not caught? We understand that this is going on for almost 5 to 6 years. Loans to HDIL were kept off the core banking systems, which is the backbone, the IT backbone of banking. Now, if the loans are not there, then perhaps it was not possible for the auditors or the RBI inspectors to actually catch these loans. But then how was the bank balancing its books? Well, it looks like money was routed through thousands of dummy accounts. We are not yet clear as to whether these dummy accounts were companies created by the HDIL group or was the bank doing this internally. We are waiting for details on that. Obviously, this has happened with the collusion of senior officials at the bank. We understand at least 6 to 7 senior officials at the bank were in collusion. Now, things started to fall apart, as they often do in these kind of cases. And here it seems that there was one breakaway official who has acted as a whistleblower and written to the Reserve Bank of India on the 17th of September. Now, perhaps in a damage control mode, the MD has gone and met the Reserve Bank of India Executive Director in charge on the 18th of September. On the 19th of September, the RBI has started inspections. But following that, there has been a confession letter from the MD to the RBI on the 21st of September, where he has admitted to the extent of loans, which is 6,500 crore and 70% of the bank's books. On 23rd of September, the RBI has superseded the board. The MD has been removed. An administrator has been put in place. Now, all of this is information that we have got from sources who are familiar with the matter. We did once again reach out to the lawyer of Mr. Thomas on Sunday. He did not answer calls. He did not respond to messages as well. Until Friday, Thomas was saying that the extent of loans is 2,500 crore, and his lawyer was saying this is not a criminal offence at best. It is a civil matter, but it doesn't look like that, although we will know further once there is a complaint filed. The administrator appointed by the Reserve Bank of India did tell BloombergQuint that they are preparing to file a complaint, which will be happening soon. We don't know whether other investigative agencies like the SFIO would come in to investigate the HDIL side, because the RBI can essentially investigate the banking side. What are the options in front of the RBI? In cases like this, the RBI has a multitude of options, but all of these options are governed by depositor interest first. Remember that depositors have been already inconvenienced, and the RBI would want to try and ease those withdrawal restrictions as soon as possible. They will certainly initiate inquiries, may draw in other investigative agencies. In the past, mergers have been considered. United Western Bank case in point. We don't know whether the RBI will go in that direction, but that is often a route, to ensure that depositors do not actually face long-term trouble. So this is a story that's playing out, early days yet, but certainly a story of staggering malfeasance at PMC Bank.
Thanks, Ira, for that. The Reserve Bank of India has also put Lakshmi Vilas Bank under its prompt corrective action framework. This comes at a time when the lender is looking to merge its operations with Indiabulls Housing Finance. Shefali Malik is here to tell us what prompted the regulator to take this action.
Well, there are a couple of thresholds to fall in the PCA framework. So Lakshmi Vilas Bank has actually breached a couple of them. So when it comes to the net NPAs, the threshold one is that the net NPAs have to be more than or equal to 6%, but less than 9%. So for them, at the end of June quarter, it was about 8.3%. And the capital adequacy ratio, they're actually falling within the threshold 2 category now, which is about less than 7.75%, but more than 6.2, more than or equal to 6.25%. So for them, the capital adequacy ratio total was about 6.46% at the end of June quarter, and the fact that they've had negative ROAs for the last 2 years has prompted the Reserve Bank of India to put the bank into the PCA framework. Now, one interesting line that came as part of the release from Lakshmi Vilas Bank intimating that they've been put under the PCA framework is that as per the on-site inspection, RBI has decided, after the on-site inspection, RBI has decided to put it under the PCA framework. So and that's interesting that probably there could be more to these numbers as well. Probably RBI might have seen more into their books, which prompted them to put it under the PCA framework. Also, so what it means is that it's still a PCA framework. They've not put it under the moratorium, but it's having a larger implication because the bank was under consideration for a merger with Indiabulls Housing Finance, and we are are seeing that kind of a reaction come in for both, more for Indiabulls housing finance, because for them it really mattered. Time and again they've been saying that, you know, for Lakshmi Vilas Bank is weak one, its capital adequacy level is really low, very weak. So it makes all the sense for this merger to go through. But the fact that RBI has, gone ahead with this PCA framework is putting questions in the minds of people, in the minds of stakeholders, that if PCA is on, then what about the merger? Is that off the table, or will it get delayed? So that is why we are seeing this kind of a stock reaction. And mind you, as part of the PCA framework, when the threshold 3 is breached, then processes like amalgamation mergers creep in. So as of now, they are breaching threshold 1 and 2 on various parameters. So it's interesting to see how this unfolds. Merger process for sure, because at least the bank might take 6 months, maybe 12 months to come out of this PCA framework, or maybe more than that. You never know. So what happens to the merger process simultaneously? That'll be interesting to look forward.
That's a big question mark. Shivali, thank you for that. HDFC Bank is not too keen on launching floating rate linked personal loans. The bank's MD Aditya Puri says consumers want surety and consistency and not variations. Speaking to Advait Rao Palepu, he says the same applies to deposit rates as well.
There is. So if you do a floating rate loan, you must tie it to an external benchmark. Obviously, the RBI has been very clear. They've just said you have to do the pricing linked to an external benchmark if it's floating rate, and you better take all your risk, including interest rate risks, into account. So as far as we're concerned, we've managed. We don't see any major problem with our margins.
What proportion of your personal loans in the personal loan segment is floating on the business loan segment? So would you be launching floating rate loans?
I don't know. In fact, there is no demand. Globally, at the lowest point of the interest rate cycle, people want to fix, not float.
In terms of the deposit side, many bankers have said they'll have to fix the liability side also. So do you see that also changing in case?
Liability side, please understand that there are a lot of people who depend on bank interest for their day-to-day expenditures. So they would not like a floating rate loan. We tried it, we will try it again, but I would say the chances of success on floating your granular liabilities is limited. You may be able to float your wholesale liabilities.
So just last two questions. We've seen the asset quality cycle over the past 5-6 years. It peaked in last March. It's now at 9.4 trillion, is what the RBI is pegged at. You're seeing PMC Bank now coming out with the exposure that they had underreported the exposure. What is your view on the asset?
Problem is you see one thing and then you make it into a molehill, into a mountain. So PMC mein kya hua mere ko pura malum nahi. But please don't extrapolate that to the entire bank.
I'm asking in terms of, has everything been recognized? How do you see the outlook?
Frankly, I don't know. I can tell you for the bank. Everything has been recognized. We've got more than 100% provisioning, and we see no strain in our portfolio. The rest you'll have to ask individual bank.
Aditya Puri of HDFC Bank. Tough times call for tough decisions. Well, automakers may have decided to keep offering discounts and also cut in prices in some cases, but that's failed to push up sales, at least in September. A BloombergQuint poll conducted among 4 brokerage houses shows all automakers failing to sell more vehicles than the same period last year. Yatin is standing by to tell us how the picture looks.
Well, Harsha, the month of September will not be, great despite the festivities starting. But one thing is for sure, be it the retail sales or be it the wholesale numbers, month on month there could be some bit of respite and improvement. Of course, dealers have blamed the delay in the GST cut on auto decision making for various deferrals that the customers have done. But now they are hopeful, since there was no GST cut. Consumers who were postponing buying decisions will probably come in the month of October. But talking about the two-wheeler space first, if you look at the entire October, as well as the September trend, last year things were much better. The base was higher, but this time, despite the festivity starting, we are expecting a 15 to 20% range, cut in the overall wholesale volumes year on year. Be it Royal Enfield as well as TVS Motors, we are witnessing some pressure with regards to the inventory levels, because of which the wholesale dispatches have got impacted for the month of September, and hence a 20% decline is expected. For Bajaj Auto, again, the export markets are not looking that buoyant, because of which there could be some further pressure on the overall September volumes. Talking about the passenger vehicle segment, Here again, Maruti, the market leader would see a probable 25% kind of a decline for their monthly numbers. Similar is the case with Mahindra & Mahindra, the automotive segment, wherein there is pressure in the UV sales as well. Talking about Tata Motors as well as Ashok Leyland, the commercial vehicle sales have been quite muted. Remember last month Tata Motors said that they are trying to get rid of the inventory situation with dealers, and hence the wholesales would be under pressure any which way. So clearly the inventory situation and lack of demand in the commercial vehicle space would be the key reason why Tata Motors as well as Ashok Leyland sales would look muted. Again, talking about the tractor segment, some silver lining here, given the fact that the monsoons have been above normal, and more importantly the rural markets are slightly picking up on the back of a better monsoon. So a flattish kind of a growth trend is seen as far as the tractor segment is concerned. But overall, this month of September is expected to be quite weak for the automotive segment.
Nathan, thank you for that. Anyone who's ever taken a train is familiar with the IRCTC, the Indian Railway Catering and Tourism Corporation, that has recently launched an IPO. This is the largest offering from the Indian Railways stable so far. Sumit Sarkar is standing by to tell us what the company does and what's on offer.
So if you see IRCTC, which is the fourth company from the railway stable and the largest one so far, is launching its IPO today, and the company is looking to raise close to 638 crore rupees, where the promoter is selling close to 2 crore shares at a price band of 315 to 320, and at the upper end of the price band, that is 320 rupees, the company will be valued at close to 5,100 crore rupees. Now the company is in the business of internet ticketing, catering services, packaged drinking water, and travel and tourism services. Now if you see on the internet ticketing business, it caters to nearly 73% of the total tickets booked for Indian Railways, and on a month average basis there are more than 2.5 crore bookings that are done. On the catering business, it provides food services to Indian Railways, and on the packaged drinking water, it sells water under the brand name of Rail Neer, and it has currently 10 operational plants which have a capacity utilization of 80% plus, and it is also in the process of commissioning 6 new plants and has proposed to build 4 more plants in the coming quarters. Now if you see the company's revenue contribution, it gets nearly 55% of its revenue from the catering business, while the remaining 45% comes from travel and tourism, internet ticketing, and packaged drinking water. However, this is on the top line front. On the bottom line front, if you see, the company generates most of its net profit from the internet ticketing business, and that's because the margin is nearly 67% for that business. For the packaged drinking water, the business margin are close to 17%. For travel and tourism, it is 15%, while for catering, it's only 11%. Although it gets nearly 55% of its revenue from the catering business, on the margin front, it is the lowest at around 11.4% for the financial year 2019.
What about the financials?
No, the company does not have any peers. So if you see over FY17 to FY19, the company's revenue, net profit and EBITDA grew at a CAGR of 10% and 9% each, while its average EBITDA margin was close to 20% over FY17 to FY19. On the balance sheet side, if you see, the company is a debt-free company with a cash balance of over 1100 crore rupees on its book. Its book value per share is close to 65 rupees, while the cash value per share is close to 71 rupees as of financial year 2019. On the return ratio, if you see, compared to FY18, all the 3 return ratio, that is return on equity, return on capital employed, and return on asset, have increased, and for FY19 it stood at close to 27%, 32% and 11.1% for the financial year 2019. Lastly, in the valuation, if you see, the valuations are much reasonable. The price to earnings on an FY19 basis is 18.8 times, price to book is 5 times, EV to EBITDA is 10.7 times, while market capitalization to sales is close to 2.7 times. Now, most of the brokerages that we went through have a subscribe rating for this IPO on the back of its monopoly type business, asset-light business model, higher dividend payouts, debt-free status with strong visible growth, and the reasonable valuations that it currently has.
Sumit, thank you. The government is also looking to divest more shares in state-run companies through the Bharat 22 ETF. Therefore, it will further fund the open offer. The offer will open for subscription this week. Nikki is here with the details on what's on offer.
Actually, this is the 4th tranche that government is coming up with, and the first 3 tranches we received a lot of oversubscription, so we're expecting some amount of demand for this as well. But then basic details first. When does the offer open for subscription? October 3rd, you have the anchor investors, and it's open for non-anchor on October 4th. Issue size, basic size is 2,000 crore, green shoe option is 6,000. Put together, it's overall 8,000 crore. Minimum application size for anchor investors is around 10 crore, and for non-anchor investors is anywhere between 5,000 to 2 lakh rupees. The underlying benchmark index for this ETF will be S&P BSE Bharat 22 TRI. The listing will be both on BSE as well as NSE. Just have a look at the composition of the entire ETF as a whole. Nothing changes dramatically per se for the fourth tranche, but then let's look at the cap out there. Market capitalization, large cap, you have 88%, mid cap index would be 11%, small cap would be at a minuscule 1%. Essentially, it's keeping it pretty safe. And if you look at the sectoral bifurcation here, it's industrial, utility, and finance put together, which command more than 20% of the entire weightage, whereas for FMCG it's close to 14%, and basic material it's close to around 4%. Let's talk about the top 5 stocks which essentially command the higher weightage in this index. It's L&T at the top, 16.7%. You have ITC, 14.3%. Now remember, the ETF is holding just ITT in the entire FMCG basket, which is commanding the weightage of around 14.3%. State Bank of India, Axis Bank, and NTPC are the remaining 3 of them. What are the benefits technically that the investors would get on investing into this? Would be first, diversified exposure to sectoral mix. As I just mentioned, it's a mix of all 4, 5, 6 sectors put together. It has reduced concentration on few index heavyweights, because the non-heavyweights would be forming around roughly next 50%. Highly liquid index, given that 97.5% of the stocks which are belonging in this category, they're belonging to FNO category. So clearly there is a liquidity coming in on account of that. And the good part is the discount, 3% to what the existing rate is right now. And look at the valuation, look at the dividend yield as compared to that of S&P BSE Sensex. There is a huge drift out there. Look at the valuations in terms of price to equity ratio and price to book value for these two, the index as well as for Sensex index, and look at the kind of dividend yield. For S&P Bharat 22 index, dividend yield is at 3.5%, whereas that for Sensex is around 1.20%.
Nikki, thank you so much for that.
Welcome.
An official of the US Treasury says that there are no plans as of now to stop Chinese companies from listing on American exchanges. This comes after a day after Bloomberg reported that the Trump administration is discussing ways to limit US investor access to China. Jody Schneider of Bloomberg News reports.
Basically, what the U.S. is saying, a Treasury Department spokeswoman is saying that the U.S. has no plans to block Chinese companies from listing on U.S. exchanges at this time. So it's saying right now we haven't decided. And also, they are not talking about, they did not in that denial say that other things were off the table. There has been, what we reported is that there has been discussion of other potential limits on U.S. investment in Chinese firms, Chinese listing in the U.S., and Chinese investment in U.S. firms. So they're saying in this one part at this time, they're not looking at that. That doesn't mean they won't in the future, and it doesn't mean that they're not looking at other things, that other things may still well be on the table. It could be potentially very important, or it could be more rhetoric. We've seen a lot, certainly, of rhetoric on both sides in recent months and weeks. But what's coming up is very significant as well. October 10th through 11th, the Chinese vice premier is leading a delegation to the U.S., to Washington, for trade talks. And right after that, some threatened another round of U.S. tariffs on Chinese imports is set to take effect. So there's a lot at stake here. And the U.S. could be doing all these things at the same time in terms of looking at those limits. But right now, they also want to set the stage for there to be serious talks with China. And then, of course, President Trump has threatened if those talks don't go well, he's happy to put in effect more tariffs.
Jody Schneider of Bloomberg News reporting that. Out of time on the show. Thank you so much for joining us on lunch. Lots more coming up on BloombergQuint.